Shibani Sarkar Kurian, she's Senior Vice President and Head of Equity Research at Kotak Mahindra Asset Management, joins us right now on the show. Shibani, thanks so much for waiting by patiently, but stock-specific news for which we couldn't ask you, and therefore had to address this news with another guest. But just on this broad point of this spate of issues surrounding banks, I mean, hitherto it was only public sector banks. Now we have a couple of private sector banks in the fray as well. Does it make you nervous about investing in banks, or are you guys sanguine about the whole situation?
Yeah, hi, good morning, and thank you for having me on the show.
Pleasure.
So when we're looking at banks, where we are structurally positive are on the retail private sector banks, where clearly two things. One, of course, the loan and the deposit market share seems to be increasing. Both in terms of loans and deposits, these banks will continue to grow at a faster pace than the market. For retail private sector banks, asset quality issues are significantly lower, which means that in terms of the reported profitability of ROEs and ROAs, they would continue to show a healthy trend. So that's where we are structurally positive. For PSU banks, we've been cautious now for a fairly long period of time. Despite the fact that there was a capital infusion which was very large and that was announced last year. But if you look at the balance sheet stress that is continuing on PSU banks, notwithstanding the other issues on frauds, etc., but the very fact that they still have to provide for a very large portion of non-performing loans means that the capital that they got last year will be utilized largely for that, and there would be very little growth capital left. And frequent changes in terms of top management, etc., continues to remain an issue. And structural and administrative reforms are still to come through for PSU banks. So that's a segment where we've been cautious. For the corporate private banks, again, especially post the February 12th circular of RBI, where all forbearance on restructuring has been removed, in the near term, you will continue to see pressure because provisioning costs will be significantly higher. A lot of loans which were in the stressed pool will now have to be recognized as NPLs, and therefore there would be higher credit costs, and that could continue for a period of time. And we also have to see how the outcome of the cases that have been referred to NCLT pans out and what kind of haircuts banks have to take. So notwithstanding what's happening on terms of frauds or management related issues, even from a fundamental perspective for corporate and PSU banks in the near term, there could be significant pressure on profitability, at least for FY19.
Hi Shibani, good morning. What's the view on the earnings? Because we kickstart the earnings season this week. We'll have Edison Bank as well as Infi coming out with the numbers. What are you factoring in with regard to the fourth quarter earnings of FY18?
So hopefully the fourth quarter will take up where the third quarter left off in terms of earnings, and we would see better trends in earnings. There are few segments and sectors where earnings growth we expect would be strong, especially on the consumer side and the auto space and retail private banks and certain retail NBFCs as well. So for instance, in the automobile space, for the MHCV segment, the numbers have been extremely strong. Two-wheelers have shown a pickup in terms of volume growth. The rural plays especially would possibly show improving trends in terms of earnings and growth. Similarly, for consumers as such, as an overall segment, we would see better trends on volumes as well as on margins because raw material costs have started to decline, and that would aid overall earnings and profitability. NBFCs and select spaces, especially those which have been able to withstand competitive pressure or operating in segments where there is less competition, will show higher loan growth. Also, those operating in the rural segment where we are seeing signs of improvement would possibly show better growth. And also because of the moderation on terms of yields, we've seen that the pressure in terms of cost of funds would also abate a bit for some of the select NBFCs where you will see better earnings. And retail private sector banks would also be a segment where, as I mentioned earlier, because of market share gains both in terms of loans and deposits as well as better asset quality trends, you will see better earnings profile. Where the segments which would see pressure would specifically be the corporate banks, the PSU banks, telecom as a space where we continue to see earnings pressure. I think the Q4 earnings overall will set the tone for how earnings will pan out for FY19 and what expectations the market will go in. At this point in time for FY19, we are looking at mid-teens kind of earnings growth, which is an improvement over last year, and we expect that the trend of improvement overall in terms of earnings would continue. On the ground, the feelers that you're getting, especially where domestic consumption and certain industrial or infrastructure related segments are concerned, the numbers seem to suggest that there is an improvement in terms of growth. But what is clearly bearing down overall, while we have a scenario where earnings is improving, is that there are macro pressures. One, we spoke about what's happening on the bank balance sheets and the need to provide, which could have a bearing in terms of the credit that they provide to the mid-corporate segment. And secondly, of course, from a macro side, we are seeing pressures on current account deficit, which one would have to be wary of, given the fact that a larger current account deficit would need funding from portfolio flows and foreign FDI flows as well.
Okay. Shivani, the other thing is what to do with, I mean, I know you addressed a bunch of sectors now, but I wanted to talk about a couple of specifics. What to do with the economy-facing companies? Hitherto, there is clarity on a bunch of other sectors because of management commentary otherwise. The one where we don't have clarity in addition to banks is economy-facing companies, wherein a clutch of names are saying that due to international order flows as well, capacity utilization is picking up, and that might show in earnings and therefore valuations will pick up. In a clutch of other names, that is not turning out to be the case. What are your conversations suggesting, and are you guys betting heavily on that pocket?
So as you rightly mentioned, it is fairly stock specific. You are seeing some segments where there is improvement in order flows. If you look at the overall infra space, the kind of growth is still driven largely by public capex and spend by government. But there are key areas where the focus is roads, railways and affordable housing. These are the three segments where you are seeing improvement in order flows, and therefore the names which have a bearing on these three sectors would see better trends in terms of orders. What we are also seeing, in terms of our overall portfolio positioning, is that cement as a space which is a proxy for infrastructure, where growth has been visible in terms of road construction as well as affordable housing, is showing better trends on terms of volume growth. Where the sector has been facing some degree of pressure is pricing. While we had earlier anticipated that prices would start to improve, but clearly because of competitive pressures in certain spaces, prices have not gone up as much as one would have earlier anticipated. We now expect that we would be in a scenario where prices would start improving, and also with better capacity utilization, you will see better profitability. Raw material pressures would possibly continue, but as price hikes happen, some of this would be offset, and that would flow through in terms of earnings. So cement is a sector where we continue to remain positive as a proxy play to the overall infra space.
Okay, that's a positive view on the cement space. Shivani, so far, if one were to look at the returns in the last 1 year or so, the theme has been metals and BFCs, which have been giving good returns. Going into FY19, what according to you can be the theme of this market?
So I think our theme continues to be predominantly domestic oriented companies and consumption. What we are seeing within the consumption space are three key trends. First, the rural space, which so far was not showing very healthy trends, are now showing trends of improvement. So rural spend is clearly on an uptrend, and the rural segments and those sectors which have a linkage to rural India would show better growth. So that's one big theme that we are seeing on the consumption side. Secondly, we are seeing increasing premiumization and increasing penetration. So the consumption basket is a fairly large basket where we are positive on. So be it automobiles, be it consumer discretionary, FMCG, or even retail, private sector banks and certain retail NBFCs, the entire basket on the consumption side is where we are positive. As we mentioned earlier, on the infra space, it is stock specific in nature. Cement is a segment where we are positive on, and oil and gas as a space is also a segment where we see that things should remain fairly buoyant going forward.